All right. Welcome to a new weekly Wednesday webinar. Good evening, everybody. Thank you so much for joining us. I see the names coming through, so please, make sure that you are ready to learn something new this evening. I want to share a quote with everybody and the panelists team as well, of course. The quote says, "The future belongs to those who believe in the beauty of their dreams." I know everybody has a lot of dreams in their lives. There's a lot of goals that you want to, accomplish as well. And here in the United States and the Federal Credit Union, your financial dreams and goals are a priority for us. And as you can see, we're going to learn something new. And this is, something that's going to set the foundation perhaps for some of the dreams that you want to accomplish, whether it is maybe buying that dream car, whether it is going to that future dream school, or your kids perhaps want to go to that future school, or perhaps buying property as well, understanding credit reports, scores, and how to improve them. I know credit can be a little tricky. I know Milton has said this before, and is that you can do a lot of things to improve your credit, but then one little mistake, maybe one late payment, can put you down again. So we want to make sure that you understand a little bit how credit works. But once again, welcome everybody for being here with us this evening. I see 21 of you, and we love it. We love it. Shout out to Miss Kim Freely. I see her on the attendee list. She's on the other side this time. So Kim, welcome, welcome. I appreciate you. Thank you for being here with us. And we miss you on this side, but we're glad that you are joining us as well. And of course, if you're a regular of these webinars, thank you for, being one of those people that always support us. And if it's your first time being in this webinar, series, welcome. And we hope this is not your last time that you'll be joining us going forward. And of course, I want to, let everybody know that if you have any questions, you have any concerns, you just want to say hello. Maybe you want to tell us where you're, connecting from, what state, shout out to the DMV. The majority of us are in the panels team. We're in the DMV area, but we have some love for Illinois as well. But if you want to tell us in the comments, you have any questions, any concerns, please make sure that you use that chat feature, or you can use that Q&A as well. And Miss Londono, what is the commitment with every question every single Wednesday?
That we will answer each and every one of your single questions.
All right. You heard it from the expert. Andrea said that she's going to read every single question live at the end of the presentation. And of course, Eli will be reading those questions as well. But without further ado, I want to pass the mic to the person that will be doing that official introduction of the panelist team. My colleague from the membership development team, Jarnika Trent. So Jarnika, please take it away from me.
Thank you. Thank you so much. Hello, everyone, and happy Wednesday. I have the amazing privilege to introduce some awesome people. I'm going to start with our amazing marketing team. We have no other than Miss Andrea Leonardo. Hello there. We have the amazing Eddie on the call tonight. Of course, he is the light star of the show with his amazing introduction. And we also have Eli on the call. Hello, Eli. And we also have Carrie, who put this amazing presentation together. We could not do it without you. Thank you so much, Carrie. And we have myself. My name is Jarnika, and I'll be assisting you guys today as well. And last but not least, we have our amazing host, no other than, no greater than, the best of the best. There's no one better that's going to knock this out of the park today. Mr. Milton. Thank you so much, everyone. And we look forward to being able to help you guys understand a little bit about what credit is. And if you happen to have any questions, like Eddie said, drop those in the chat and we'll be happy to help you all answer some of those questions. So without further ado, we'll go ahead and we'll get started. Unless Eddie has anything else he wants to add. Awesome. All right. Milton, take it away.
Awesome. Well, thank you so much, Jarnika and team. So excited to be on this side of the panel this time. I haven't presented in a while, so I might be a little rusty. So I ask for forgiveness, ahead of time. But again, just just want to start by saying thank you. Thank you. I know we have a lot of people in attendance, and we appreciate you as always. It is a privilege to have you come and join and spend, an hour of your time. I know a lot of you have a busy schedule, but again, we are grateful for this opportunity. So, Carrie Lazar, if you don't mind, I'll go ahead and start sharing my screen so we can get into the agenda. And you'll give me 1 second here. All right. Just 1 second, and let's take a look. Yep. Beautiful. All right, perfect. So I'm gonna go ahead and turn off my camera so we can focus ourselves into the agenda for today. As you can see, we have a lot to cover today, and it's all key to understanding your credit reports and score. Obviously, we're gonna start by talking about why is credit important, what's on your credit report, obtaining your credit report, how credit scores are calculated, how to build credit, and talk about some of those common myths that people talk about credit. I'm pretty sure you all have heard a thing or two when it comes to credit. And last but not least, we're gonna talk about tips for using credit cards wisely. So, with that being said, before we get started, we want to talk about all the ins and outs of credit reports and the scores. It is important to take a step back and consider why credit is important in the first place. I have a question, and one thing I forgot to mention at the beginning, and that is that we want to make this an interactive webinar. So I'm going to start with a question. So I want you all to use that chat feature. And my question for you is, what are some of the examples of the things that you had needed to apply for credit recently, or examples of things that you have been held back from not having sufficient credits? Again, if you were to go back in the last 6 months, back to the beginning of this year, what are some of the things that you that you had obtained and that you had to have your credit pulled? And what are some of the things that you were unable to obtain because you didn't have sufficient credit, or maybe your credit wasn't good enough in the eyes of the creditor? Go ahead and put those items on the chat for us. My team is going to be reviewing them and reading them out loud towards the end of the presentation. But definitely wanna hear your input when it comes to some of the things that you have perhaps applied for, you obtained. Maybe you got a car, perhaps you got into your dream home. Whatever it is, I want to hear about those and see those in the chat. While you're doing that, I want to start talking about why credit it's important, even when it comes to employment. Believe it or not, having good credit may help you land your dream job. Did you know that 38% of the employers do credit check? This doesn't mean that having a bad credit is going to stop you from finding your job, but it may be used in determining whether or not certain positions are offered to you. It is important to know that employers only have access to your credit report, not your credit score. That is one thing I want to make clear. And whether or not credit is a factor in getting employment largely depends on the industry. Some of those industries that I can tell you right now, right off the bat, will definitely be checking and putting your credit report. Are going to be any businesses that are related to finance, perhaps government positions, and especially those that require security clearance. And again, as I stated early, they only see your report and not your score. So that's something that I do want to make sure that it's clear for everyone. And I just want to give you an example. And the reason why I want to give this example is actually because I'm speaking from experience. Did you know that if you wanted to work at any airport and enjoy the TSA, the Transportation Security Administration, they will do a credit check, and if they find that you owe more than $7,500 or more in debt, they are going to require you that you show them a plan to pay off the debt before they make any offer letter, offer of employment. Again, if you owe more than $7,500, you are required to show a plan that you're going to pay the debt. That is just an example that I want you all to keep in mind, and as to why credit is important, especially when it comes to employment. Now, with that being said, your credit history comes into play when you are looking to rent or buy a home. Even though renting doesn't actually involve borrowing money, that obviously compared to getting a mortgage, but believe it or not, a lot of management companies, they are going to go ahead and pull your credit because they want to know whether or not you are responsible, and most important, are you going to be able to pay the rent on time, and what kind of history you have had in the past, especially when it comes to rent. And last but not least, I'm pretty sure everyone knows that if you're going to get into a mortgage, credit is definitely one of those big factors that a lender is going to look before they make a decision as to whether or not they're going to issue you the loan. So very important for you to keep those things in mind. And finally, having good credit might make the difference in getting the loan that you need. Anytime you need to borrow money, your credit is going to play a pretty big role determining what kind of terms you get, right? So what happens if you borrow the money and you don't have good credit, right? I'm pretty sure you all seen, perhaps heard the ads or seen the ads that there's some companies out there that say bad credit, no credit, bankruptcy, no problem. While this places often approve you for a loan, it could be at an extremely high interest rate. For example, you might get an auto loan at a 25% interest rate. That's the 25% APR on a car loan. You know what that means? That means that the odds are you perhaps paying double, or in some cases, triple the amount of what someone will normally pay if they have good credit. So I want you to keep that in mind. This is an example right here. As you can see, a 25% on a car loan versus a 7%. You are paying 3 times more than somebody with a good credit. So credit is so important, something that it really, really, you had to make sure that you focus on. And once you build it, keep it. Do everything possible to make sure that your credit never goes down, because as I'm going to get ready to show you this example here, we have 2 people on this chart. As you can see, we have Diego and Angela. The 2 of them are applying for a mortgage loan, $250,000, just so that we can make it easy in terms of comparison here. Both Diego and Angela, they have the similar work history. They have a stable employment. They've been employed for more than 5 years. They make about the same amount in income. The only difference here, as you can see, is that Diego's credit score is 660 versus Angela 750. So when it comes to a mortgage loan, guess who's going to get a high rate, right? So Diego's going to get a 5.25 versus Angela getting a 4.63 with monthly payments of $1,381 versus $1,285. So if you look at the big picture, in this example, having a higher credit score for Angela meant that she saved $34,000, $34,258 to be more specific. That is a huge difference, especially when you start looking and getting into loans like a mortgage, right? So mortgage loans, we all know one thing for sure. It's probably going to be the biggest purchase you will ever make in your life. So if your credit is not where you want it to be, you better prepare yourself to pay a little more than what somebody else will. Because again, in this case, you see there's a difference of over $30,000 that one person is paying just because the credit score is not ideal. Now, I will ask you this question. What advice will you give to Diego before he decides to whether or not to move forward with this, with the purchasing the house? And just so that I'm clear, these rates that we're showing you right now, these are not the current rates. I want to be clear because I don't want anyone to get confused and say, "Oh man, are we back to the 4% interest rate?" No, we are not. This is just as an example that we wanted to share with you, because in reality, the rates right now are still in the low six, high fives. So if we were to use today's rates, you would probably be even more scary to see the amount of interest that Diego is going to pay for the life of the loan, just because his credit score it's not where where he wants it to be. So one of the things that we will advise to Diego is that perhaps hit the brakes for now, work on improving his credit score. Oftentimes, I know we are eager to get into a property, but really you have to look at the bigger picture. And if that means pausing the home purchase and taking an extra 3 months or 6, will that make a difference for you? Then please do so. But again, you have to be very mindful and know the importance of credit, because again, as you can see here, it could really play a huge difference when it comes to getting any loan, especially when it comes to a mortgage loan. So let's now turn our attention to the credit reports. As the credit report contains some of the most important pieces of information that creditors are going to look when determining if and what terms they're willing to extend to you. So with that being said, before we do any of that, it is important for you to know the 3 credit bureaus. I think by now everyone is probably familiar with them, but if you're not, there are 3 credit bureaus that report credit information for everyone. One of them is TransUnion. The other one is Experian, and Equifax being the third company. And when it comes to apply for any credit, different financial institutions, they may review different credit bureau reports. In some cases, like if you're applying for a mortgage, the lender may review all the 3 credit bureaus. This is part of why it's important to be on top of what is reporting with all the 3 credit bureaus, and it is recommended that you review your credit report from all the 3 bureaus at least once a year. And the reason why we say that is because there is different information that reports to all the bureaus, and also in many cases that information is going to be slightly different because some companies take longer to update your file. So that's why we always say, if you're going to get into if you're planning on buying getting a mortgage loan or any loan that is going to be a significant amount, try to review your credit at least 6 months in advance. It is recommended that you do so just to be on the safe side. With that being said, you may ask yourself, so what's on your credit report with the 3 bureaus? So right off the bat, I'll tell you all your personal information. So anything that includes your name, your social security number, date of birth, address, employer, this is used for whoever is accessing your credit file, right? Because they need to make sure for fraud purposes that all your information matches, that it is in fact you and not someone else, because I'm not sure if you know this, but there are so many people, then oftentimes there are people that have similar names, perhaps even similar birthdays. So you want to make sure that they have the right information. And that's one of the first things that the credit report is going to include, all your personal information. Also, any credit accounts that you have. So this is going to include any credit cards, personal loans, auto loans, mortgages, student loans, you name it. Anything that has to do with you having a hard inquiry when you apply to get something, all of that is going to be reflected on your credit report. And that is obviously, again, it is important for you to know that. Also, any collection accounts. So we talked about the type of loans that report on your credit, right? But think about perhaps any utility bill company that you use for those that have, pay for water, cable, internet, to name a few. Those companies, they don't show up on your credit report, but if for some reason you happen to be late or you become delinquent, what will happen is that they will report you to the collection agency, and any collections, in essence, will be reported to your credit report, and that will have a negative impact. Same thing for let's say the public record. So an example that I can give you is if you file for bankruptcy. A bankruptcy is considered a public record, and that is also something that will be reflected on your credit report. Last but not least is going to be all the credit inquiries, whether it's hard inquiry or a soft pull. All of that information will be on your credit report. So it is important, like as I stated at the beginning, to make sure that you are reviewing your credit report at least once a year from all the 3 credit reporting agencies. Now, let's talk about what is not on your credit report. Again, your credit report does not contain any information related to income, assets, or savings. So a person can have excellent credit but no savings, or on the other hand, a very wealthy person might have a poor credit but be very wealthy. So this is why lenders will often look at all of these pieces of information to get a financial picture of where you stand. So remember, income, assets, savings are not going to be reflected on your credit, but anything else, whenever you apply for loans, any inquiries, any open loans, outstanding loans that you have will be there. And it is important for me to make this very clear. A credit score, it's not a financial health score. As I stated early, somebody who's very wealthy can have a lot of money in savings and different assets, but could easily have a poor credit score. Why, you ask? Who knows? Perhaps they don't have the need of borrowing money, and so they can care less as to what shows on that credit report or credit score, to be more specific. So definitely something to keep in mind. Now, with that being said, there is no requirement in the Fair Credit Reporting Act for credit reporting agencies to remove positive information, such as on-time credit payments. They can remain on your credit reports indefinitely, especially if the account remains open and active. Even after a positive account has been closed or paid off, it can still remain on your credit report for as long as 10 years. Having more good information helps you strengthen your credit history, and obviously is going to increase your credit score. And we're going to dive a little more into it as to how having a longer an account for a longer time will have a better impact on your credit score. And we're going to talk about that later on, but it is important to keep that in mind. Also, it is important that the information on your credit report is accurate. So according to a study conducted by the FTC, the Federal Trade Commission, 1 in 5 people have a mistake on at least one of the credit reports companies. Again, let me repeat that. 1 in 5 people have errors in their credit reports. So let's talk about how to get a copy of your credit report. It is recommended, again, as I said earlier, that you review your report at least once a year to make sure everything is accurate, to ensure that you're aware of everything that is reporting. You have the option of getting all the 3 reports at the same time if you like. I'm sure everyone knows this, and you may ask, how do I get that? Well, it's pretty easy. The recommended place, where you can get your report, it's the annualcreditreport.com. It's the website that was set up as a result of the Fair Credit Reporting Act that states that you're entitled to receive a free copy of your credit report from each of the 3 credit bureaus. So that is definitely a right that you have. And get this, during COVID, the credit reports actually became available for you to get a free report once a week. What does that mean? That means that you don't have to get just one report a year. If you want it, you can get as often as a weekly report. Would I recommend for you to do that? Probably not. Now, what would be the recommended time frame? As I stated, it all depends on your situation, where you are in life. If you are planning a big purchase, we recommend that you check your credit report at least 6 months in advance. And the reason why we say that is because it gives you enough time to make any corrections if you see that something is not adding up, or if there's incorrect information being reported on your report, then you want to fix that. And 6 months is a good time frame for you to get that corrected. So what if you don't feel safe in using a computer, and you don't want to submit your information online? Then guess what? You can request a form to be mailed to you, and then you can go ahead and manually fill out an application to request your credit report. Simply download the form and mail it to the PO box that you see here, the PO box 105 281 in Atlanta, Georgia. Or if you want to give them a call, 877-322-8228, and they will go ahead and mail you the form so that you can fill it and submit your request to have a copy of your credit report. So that is one thing also that I wanted to add as well. So again, for those people that don't feel safe filling up their information on a computer, you may do so by sending it by mail. With that being said, it is also important to know that your credit reports are free. However, if you want to look at your credit scores, those are not. Typically, you're going to pay anywhere between $6 to $8 per company. So per the 3 credit bureaus, their fees are they vary. So it is about $6 to $8 how much the fee that they're going to charge you. Now, did you know that if you ever apply for a loan and you get denied, by law, you are the company that you're applying to obtain credit for. By law, they are requiring you to send you a adverse action that gives you your credit score and the reason why you were denied. So you will receive the score that they use in the decision, and that will be mailed to you. But again, do we recommend this option in order for you to know your credit score? The answer is no. Absolutely no, with big all caps, NO. Never try to get your credit score by simply applying to a loan that you know you're going to get declined, and then that's going to give you your credit score. Don't do that, please. Please, please, please don't. Instead, use your resources, especially the ones that we offer here at the U.S. Senate Federal Credit Union. Did you know that you can actually get your FICO score for free with us by simply going into your online banking? So my USSFCU online and mobile banking will give you your FICO score for free. You don't have to pay those $6 and $8. But again, if you want to look at all the 3 bureaus, that is the fee that you are going to be paying if you want to look at your actual credit score. With that being said, let's say you get your report, you're looking at it, and you see that there's something there that is not correct. So how do you go about fixing that information? Well, it's pretty easy. The first thing that you want to do, if you see that is coming from perhaps a lender that you have a loan with, what you want to do is you go ahead and file a dispute with the company that is reporting that information to make sure that they update it. If they're, for instance, if they're saying that you missed a payment or you were late on a payment, but you have that information that it wasn't, then you can go ahead and do so and file that dispute with them. If that doesn't fix it, then guess what? Then you can go ahead and file the dispute with the credit bureau. If it is reporting on all the 3 of them, you will have to reach out to each one of those credit companies to file a dispute and let them know what's going on. Normally, this will take anywhere between 30 to 45 days for them to update that information. If they find that you are correct and that there's nothing there that should be fixed, they will go ahead and make those changes for you. However, if that still doesn't work for you and then you are unsatisfied with the outcome by going into the lender or reaching out to the three credit bureaus, you still have the right to file a dispute with the Consumer Financial Protection Bureau, the CFPB, by simply going into their website, consumerfinance.gov/complaint, where you can file your complaint, or you can give them a call at 855-411-2372. But what if that information is actually not supposed to be there? What do you mean with that? That means that, well, there is something there that you never apply for. So guess what? This is the biggest fear for a lot of people, and I include myself because I've been a victim of it, and that is identity theft. So if you get your credit report and then you start seeing a bunch of inquiries and perhaps even loans under your name that you have no idea that they were out there, but now you see your report, and that is pretty much your wake-up call that, hey, you need to take action right away. What's the first thing that you want to do? Again, it is recommended that you freeze your credit score right away. Freeze it, freeze it, freeze it. And you know what? I'll take even a more aggressive approach to this. Even if you're not a victim of identity theft, your credit score shouldn't be open. Again, your credit should not be open. Everyone should have their credit frozen. If you know that you're going to apply for credit, then guess what? You can go and reach out to the three credit bureaus and ask them to temporarily lift. You can set a date. I want my credit to be open from today all the way up until a certain date. And what happens after that? Your credit goes back and it's frozen. The reason why I say this is because we have seen the number of cases of people's identity getting stolen increase by the months. You know what? Not even months, by the weeks. We see so many cases of people falling victim of identity theft, and it's scary. But one of the things that you can do to prevent this is by simply freezing your credit, have your credit frozen so no one applies for credit. And if they do, the lender will get a message saying, hey, credit's frozen, contact the person to verify that in fact it's them applying for this particular product. Even better, if you're a victim, they can add remarks saying that that you have been a victim of fraud and that they had to take an additional step to verify to make sure that it is in fact you, the person applying for credit. And obviously, if that is you, if that's ever happened, like it happened to me, the first thing that you want to do is that you want to file a report at identitytheft.gov, and that is going to help you pretty much with everything that you need to get your life back. It is definitely one thing that I don't recommend it to anyone, but if it happens, we want you to know that there are resources that are available to you to take action and act right away. Don't wait long. The first thing, again, that you should do is freeze your credit. Even if you're not a victim of identity theft, your credit shouldn't be open. All right. With that being said, how credit scores are calculated. I'm pretty sure this is one of the reasons why we have a lot of people coming in and being part of this webinar, because we want to make sure that you understand what is on your credit report and making sure that the information that is reporting is accurate. And it is important because your credit report is used to calculate your credit score. So any history that you have in there is what's going to be, is how they're going to determine what it's going to be on your credit. So let's do credit 101. So credit score is a 3-digit number that uses that information on your credit report to quantify the likelihood of repayment by reviewing how you manage previous accounts. It is meant to reflect how of a risk you are or you may become to a creditor. if they want to extend credit to you. The scores are going to range from 300 is the lowest, all the way up to 850. If someone tells you I have a 900 credit score, they are probably talking to you about something else. Again, your credit score is a range between 300 all the way up to 850 for a person that has excellent credit. I will say though, zero, it's actually a number two. And you will see that in the event if a person has never had any credit history at all. So if you ever see a zero next to you, don't be afraid. Don't go in panic mode. It's totally normal. It just means it just means that you never had credit before. Therefore, there's nothing on your credit account, credit report. So that's all that means. But once you obtain credit, then you better believe that you're going to be between that 300 and all the way up to 850. With that being said, let's talk about FICO versus VantageScore. The FICO score is the most widely used scoring model. Let me just get that out of the way. And the other model, which is getting more popular nowadays, which is the VantageScore. It is often used by sites that offer free credit scores because there are different credit scoring models. Your score may vary depending on where you check it. This doesn't necessarily mean one is wrong. It just means that there's different scoring models, right? And how they look at things. Some of these companies, again, they're gonna look at scores slightly different. So don't panic. If for some people that I can name one company, I believe Credit Karma, if I'm not mistaken. Credit Karma, their scores are going to be a lot lower versus if you were to check your credit with the Experian app. Just to give you an example. The reason being is because one is using one system and the other one is using another one. So if that ever happens to you, just know that there's a reason why, and then most important is because they're different companies. They look at different things a little different. But at the end of the day, it really matters what's in there and your behaviors on how you use your credit. With that being said, the 5 score factors. This is in essence the 5 key factors that go into calculation of your FICO credit score, which again, as I stated earlier, is the most common scoring model used by most lenders, the FICO. So if you look at here, and again, forgive me, my German Shepherd is making an introduction like he does from time to time, and that's him in the background. So if you hear a dog barking, it is my German Shepherd Nico. He's probably greeting my neighbors, but my apologies on that. Getting back to the presentation, so the 5 key factors, as you can see here, are the first one is going to be your payment history. That carries 35% of the weight. The next item is your amount due, or better known as utilization. That's 30%. Length of credit history is 15%. New credit is 10%, and credit mix is 10%. Let's dive in more into each one of these key factors. So as you can see, the largest factor impacting your credit score is going to be your payment history. So this is why we emphasize the importance of making your payments on time every month. It's going to be the best thing for you to do to make sure that you are building your credit, or if you already have credit established, that's going to be the key for you to make sure you maintain your credit. What I mean with this is that even if you're only making your minimum payment, trust me, minimum payment versus no payment, you definitely want to be on the minimum payment. So if you can pay more than what's required, just by making the minimum payment, is going to be a huge relief for you to know that that is pretty much one of the biggest things that a lender looks when it comes to compounding your credit score. Now, the next thing, again, as I stated, and this is the second largest factor, everything else, as you can see, is going to start declining. But your payment history and the amounts that you owe is going to make up 65% of your credit score. So 30% impacts on the amounts that you owe. So the creditors, what they want to see is any balances that you have, and are those balances decreasing or are they going up and down over time, right? So, and this is why we say the credit utilization especially looks at the revolving. So anything that you have revolving, such as a credit card, if you have a line of credit, anything that you can pay down and then reuse the balances because you made those payments, it is important for you to be very mindful of how you're using that. It is recommended that you don't use more than 30% of that amount of the credit limits. So if you have a credit card, I'm just going to use a easy amount here. So if you have a credit card for $1,000, the recommended amount that you want to use on that credit card, it's going to be 300. So that's 30% of your credit limits. Never try to use more than that. If you do, it's okay. As long as you are paying off the balances. But again, never try to use more than 30% of the line of credit that you have available. So whether it's a credit card or personal line of credit, or even for those homeowners that have a HELOC, a home equity line of credit, you never want to go past that amount. So it is highly recommended, especially if you are in the building or establishing credit. It is important to keep that in mind. Now, moving on, 15%, it all depends on the length of credit history. This is why, if you remember what I said early on, it is important to have accounts and then that you keep them open as long as they're reporting good credit for you. Because the length of credit history is going to give you a 15% of what your credit score is going to be made out of. Again, it's going to include the age of your oldest account and the age of your newest account. And then what they do is they're going to get an average between all of your accounts. The longer credit history, as I stated, the better it is for you. So keep that in mind. And next, it's going to be that new credit. So this is going to be 10%. If you ask why, well, the lenders will want to know is your behaviors. How often are you applying for credit? Are you applying for a new credit once a month? Or are you being more responsible and perhaps only using it once or twice per year? Again, it really depends on your behaviors, and that is one of the things that will have an impact. And let me give you an example. So I'm using the 3 months example here. If a person applies for credit to 3 different products 3 times in 3 months, that is what that's going to do to you. It's going to hurt you at the beginning, as long as if you get those loans or if you get those products and then you stay on top of your payments, and if you get a credit card, if you're not using more than 30% of the available limit to you, then you're fine. However, it is going to have an immediate impact, because what happens every time you apply for credit is going to be a hard inquiry. And those are going to stay on your report up to 2 years. So let me clear that. Whenever you apply for credit, any hard inquiries that show on your credit report, they will stay there for up to 2 years. So it is important to keep that in mind. And last but not least, is going to be the credit mix. And this is the last factor that obviously is going to have an impact. It's only 10%, again, similar to new credit. And the reason why this is here is because the lenders, what they want to look is to see how responsible and how can you manage multiple debts, right? So are you just having credit cards, or are you having a combination of perhaps a credit card, a car loan, a mortgage loan, perhaps a personal loan? Having a good mix of credit, it's also going to help you to build credit. And again, if you already established credit, it's going to help you keep it up. So it's very important for you to keep that in mind. So once you see all of this, the pie is not complete. 35%, 30%, 15, 10, and 10. And again, as you can see, as I stated, the payment history and the utilization amounts is what really makes the most impact on your credit score. So if you ever wonder if you are now in a phase where you're like, man, I want to build my credit or fix my credit, what do I need to do? Well, if you already have credit, these are the two areas that you have to focus right away: how much you owe and how is your payment history. It is, again, important that you are stay on top of your credit of your monthly payments. Don't fall behind and don't use more than what you really need to. um, I want to show you all here an example of a credit comparison. Again, we're bringing back Diego and Angela. As you can see here on these examples, Diego has a credit card with a limit of $1,000. Angela's limit is $10,000. The balance for Diego, it's $800, and the balance for Angela, it's $5,000. In this chart, as you can see, Diego is paying off the entire balance, the $800, versus Angela, it's only making the minimum payment. So I got a question for you all. Who do you think has a better credit score in this example, and the reason why? Go ahead and submit your answers on the chat. I want to see who do you think will have a better credit score, just by showing this chart here, this comparison. And I'm so sorry, but I keep calling out Diego for some reason, but this example is probably gonna make him look a little better, just because, as you can see, he's paying off the entire balance. And Angela, she is only making the minimum payments. So I see some chats coming through, and let's take a look at the chart. So the person with the better credit score, it's going to be Angela. You may ask, why? Why is Angela have a better credit score versus Diego? Diego is paying the entire balance, right? And Angela is only paying the minimum payment. Well, guess what? This is where when we talk about the utilization factor, the 30%, as you can see, Diego is going all the way up to 80% of the credit limit, versus Angela, it's only using 50%. So she is being more mindful when it comes to the amount of money that she's using from the available line. But it's a great reminder of what I stated early, that a credit report, credit score is not it's not something that determines your financial health score. Because I can tell you, just by looking at this, it seems like Diego is more responsible than Angela, because Angela is only making minimum payments, and guess what? Angela is going to pay a lot more interest on that balance that she owes, because she owes a lot more money than what Diego does, and Diego is just paying the full amount. But for credit purposes, it just happens that perhaps Angela knows that she's cracked the code, because she is not going over 50%. Although ideally, as we recommended, you never want to be more than 30%. Angela is a little over that. She's at 50%, but still she's making those payments, and she is not going over 50%. If she stayed at 30% or less, her credit would be even higher than what we saw early. So some of the things that you want to keep in mind for sure. Now you might want to ask, how do you build credit, right? So let's turn our attention on how to build the credit. So if you are a person that has no credit history, and you say, you know what, I need to build credit because I'm planning on getting my first car. Even better, I want to buy get a mortgage, in the next 3 years. But you look at your score and it shows 0, or perhaps you had a few bumps in life, and then you had a couple of setbacks, and now your credit is pretty low. So let's talk about that. As you focus on building credit, again, we want to make sure that you review and you establish a plan. How you do that is by creating a budget. A budget is so important when it comes to building your credit, believe it or not. And this is one of the things for those that have been attendees in our weekly webinars. And especially when I used to do a lot of this, I will always talk about the importance of having a budget. And here I am back again and talking about the same thing on how important having a budget is for everyone. Because it truly makes a difference for everyone. So once you have a budget, you're gonna determine, right, the consistent income that you have. Is it enough to cover your monthly expenses? Do you have at least several $100 in savings to cover for minor emergencies? And if you open a credit card or add any loan payment while you're struggling financially, this is actually going to hurt you instead of helping you, especially if you're looking to rebuild or build credit. So some of the tools that you want to use to build credit, the most popular thing and the thing that we recommend for most everyone is to get a credit card. Again, if you have no credit, then you're probably going to get declined. But if that's the case, then guess what? There is the secure credit card option that we recommend for everyone. The way that a secure credit card works is you come to a lender, make a deposit. For the sake of time, I'm just going to give you a quick example. So you deposit $500, the lender goes and issues you a credit card for that amount, and then you treat that secure credit card as a regular credit card, because what it does is that it will start reporting your history. How much money are you using? Are you making those payments on time? And if so, that is going to start reporting positive credit into your file. And if you were one of those people that have a 0 credit score, then this is going to start bumping your number from 0 to whatever, wherever you fall in terms of your behaviors when it comes to credit. Also, there are credit builder loans as well out there that you can look into. Another option, and this is one that I recommend, is perhaps joining somebody as an authorized user on a credit card. You definitely want to make sure that you trust the person that you're doing this with, just because both of you will be liable. And if one person derails, then it's gonna have an impact on the other person. So you definitely want to be very mindful of that. And last but not least, you can always become a co-signer on the loan as well too. That is going to help you establish and build credit. Now, let's go into some of those credit myths that I'm pretty sure you all seen, and you have heard. I almost feel like I'm one of those myth buster guys. If anyone's seen that TV show, it's an old show. I'm not sure if it's still around, but I used to love watching that. And then they will do the bust all the myth that exists out there, and then proven whether or not the myths were true or not. So let's talk about those myths when it comes to credit. The first one, closing a credit card will hurt my credit score. How many of you think this is true? How many of you think it won't? And again, this is something that being in the financial industry, we hear this a lot. That if you close a credit card, that's going to hurt your credit score. And let me tell you, the myth in this particular case is going to be half myth. And the reason why I say half is because it depends on the person's situation. And I want to give you a quick samples here so that you understand where I'm going with this. So we have two people here. So we are moving away from Diego and Angela, and now we're gonna focus on Sarah and Katie. So Sarah has 3 Max credit cards. She paid off the first credit card, and then she decides to close it because she doesn't want to be tempted. She had 3 credit cards. They all were for $1,000 each, and then she was maxing all of the credit cards. Now, Sarah got a little bit of a bump and decided to pay off the one of those credit cards. And just because she didn't want to have the temptation of going back and dipping into it, she decided to close it. So in this case, believe it or not, this is actually hurting Sarah. And the reason why is because she is now back to having 2 Max credit cards. And so her available credit decrease from having $1,000 available to now having nothing because those other two credit cards are still maxed out. So in this particular example, Sarah will have a negative impact on her credit because remember what we talked about, the utilization. So she is maxed out on the two credit cards and she has no more wiggle room. So closing one credit card that was paid off is actually going to hurt her because now she is losing $1,000 of available credit that she no longer has. Now, if we focus our attention now into Katie now, she actually has 5 credit cards and all of the balances are zero. So she says, you know what? I don't need to have too many of these cards. Let me go ahead and close one of them. So because Katie has no balance, this is not going to have a huge impact like it did with Sarah because, again, her limits are still going to decrease by a little, but because she doesn't owe anything, that is actually going to be good for her because it's not she won't have the temptations that perhaps Sarah will have if she was to have all of those cards open and being at a risk of maxing those out. So again, little to no impact for Katie and most definitely a negative impact to Sarah because of that utilization that she's having there. All right. Myth number 2, checking my credit will hurt my credit score. How many people think this is a myth? How many people think this is not? So, with that being said, checking your credit score, will not have an impact. The reason being is because when you do so, it is translated as a soft inquiry. So a soft inquiry will never show as a credit pull. So that means that your score will have no impact. Now, keep in mind, if you do apply for a loan, if you do go ahead and submit an application for a loan, that will have an impact and it will lower your score. Not by many points, because it goes back to what I was saying earlier, right? About how responsible and how often you're checking your credit. That's going to show the difference in what kind of score you have. So very important to keep that in mind. And coming down to the end here to the stretch line, we definitely want to give you some tips again for using credit cards wisely, since credit cards is probably going to be one of the most common methods that people use to access credit. And with that being said, one of the tips that we want to recommend is that you keep at least one credit card for as an emergency fund. Use it at least once per month. Only make small purchases. Again, the utilization, try to keep it below 30%. And if you're doing that, probably the chances of you paying that in full are going to be a lot easier to manage that. And obviously, we recommend that you monitor your credit report at least once a year. Remember, because of ever since COVID, the credit reports with all the 3 credit bureaus are now free, available to you once a week. So do we recommend that you checking your credit every week? Probably not, but try to do it at least 3 times per year, and you can mix it up with all the 3 credit bureaus. So it is important for you to do so. Now, something that I also want to highlight, and that is take advantage of the resources that you have available. We talked about us here at the credit union. We can help you look at your FICO score for free. There's no fees for that. We also have a great partnership with GreenPath. So GreenPath actually offers certified financial counselors. This is a national nonprofit organization that they can sit down with you. They can do a budget and credit report reviews. If they do so, it's going to be under a soft pull, so it's not going to have an impact again on your credit. But they can also help you and talk to you about renting, mortgage, home buyer counseling, you name it. They even offer debt management plans and student loan counseling. So if you ever want to talk to them, please reach out to them. Here's their information, 877-337-3399, or you can go to their website at greenpath.com where you can talk to them. And again, just want to take this time to say thank you for the opportunity. We really hope you enjoy this presentation. I see there's a lot of a lot in the chat. So Eddie, Jernica, Andrea, and Eli, I'm going to hand it right back to you guys.
Thank you so much. Awesome. That was an amazing presentation, Milton. I hope that you guys learned a lot of information. I know I did. I don't know about Eddie, if you want to jump in there and say a little something about what you learned, but this was amazing.
No, I like, that each time we go to these presentations, you may think that, oh, we know it all. I think I heard it before. But the fact that we saw the breakdown on the screen gave me, a better perspective as to like, oh, this is how my, credit is calculated. So, it was great information. It was a great presentation, and we love the engagement as well. So I want to pass it on to Andrea and Eli for the questions of this evening. So guys, take it over.
Of course. So thank you, Eddie. Thank you, Jarnika. And thank you, Milton, for presenting tonight. It was amazing. If you so the first question is, if you reduce your utilization, how long does it take to influence your FICO?
That's the next
Hold on, sorry.
right.
And I typically use my credit card because of the percentage back, etc. Okay.
Awesome. No, that's an excellent question, and I'm also going to ask my colleague Jernica here to jump in as well too, so you just don't hear from me and anyone else in the panel to also pitch in. But to answer your question, normally it's about 3 months. So 3 months is the average time, and the reason why we say 3 months is because oftentimes the credit bureaus take a little time to update your reports, and that is in essence what's going to have the impact on your credit score. So give it 3 months. Once you pay down the utilization, you break that utilization to 30% or less. After 3 months, you're going to see a huge boost into your credit. In some cases, it's even reported immediately. You might get an alert. I know for instance, I use Experian myself, and every time I pay down a big chunk on any of my cars, I get a message saying, "Hey, your FICO score went up for bringing down the balance on one of your accounts." So, but more realistic again, just because if you are, especially if you're thinking about buying a home, and all of that, that can take up to 3 months to update in all of the 3 credit bureaus. So it's just something to keep that in mind.
Thank you very much, Milton. Another question that we have here is, how long does it take for a bankruptcy to fall off your credit report after the 7 years?
That's an excellent question, and you actually said it right there, Eli. For a bankruptcy, it depends. If you do a Chapter 7 or a Chapter 13, so Chapter 7 will wipe everything for you, and it can take up to 10 years versus a Chapter 13 where you make an arrangement with the creditors, that can stay in your record for up to 7. So 7 years for one and 10 for the other one. So it depends on which bankruptcy you filed.
Okay, so thank you. And the next question is, what is the significance of a FICO score mortgages?
So for mortgages, again, it really, that's what the lenders are looking for. So like for us, as a United States Center for Credit, we're going to look at your FICO score because we want to look at all the 3 bureaus. And we're going to do an average as to where you are between the 3 of them, and that determines your rates. So the FICO score is pretty much what's going to determine as to what kind of rate you get. Ideally, again, anyone that has a 750 or above is going to get the best available rate, versus someone that's going to be below that. So we have excellent credit, good credit, average credit, and then poor credit, where again, you don't want to be at the average or poor credit if you're looking at a mortgage. But if that's the only route to go, then do so. But look at opportunities to continue to improve your credit, and then you can always refinance that mortgage loan down the road once your score has improved. I will say though, because a mortgage is one of those type of loans that will take a lot takes a lot of time for you to make a little dent to it, because all your first payments, the first few years of payments that you make into that loan are not going to go into the principal. Only a very small percentage of your payments will go into the principal. Everything else is going into the interest. So so keep that in mind. That if you decide to refinance after 2 years, the balance on your mortgage will not be that significant, because you probably got a higher interest rate, I'm sorry, and because your credit was low. But now that you improve your credit, you're probably gonna get a much better opportunity, given that the rates have dropped. But that is the impact that will have on yourself.
Thank you. We also have an attendee wondering if there's any way to work directly with the credit monitoring agencies.
Can you repeat that again, Eli? I'm sorry.
Sorry about that. They were wondering if there's any way to work directly with the credit monitoring agencies.
Absolutely. I mean, especially when it comes to disputing things, you can reach out to them. They have the forms available. I myself, like I said, when I became a victim of identity theft, I actually was working with all the 3 credit bureaus to try to get my information fixed. And you can reach out to them directly, and they can work with you hand in hand. Obviously, on the disputing side of things, it is highly recommended.
Next question is, how is medical debt affects your credit? Like, please discuss.
So medical debt would only impact you if it goes into collection. That is the only time where that will have an impact, just because it goes into collection, and in some cases, depending again on the company, if they take you to court. Now that could become a public record. Right? We talked about bankruptcy being one of those items that show up on their public file. Being sued could also be on the same boat as well too. So that's definitely something that you want to keep in mind.
Thank you. Another question that we have is, I understand the government is taking down the CFPB. Is that still available to file disputes with?
It is still available for now. I know with the new administration that that was one of the agencies that they were going after. But it is my understanding, and Carrie, correct me if I'm keeping honest on this one, but I believe it is still an active site where you can go. But I know that was definitely one of those departments that they were looking to to consolidate, if you will.
Next question is, out of curiosity, if you have a credit card without a credit limit, how is that factored into utilization?
That's you know what, it doesn't happen often, but I seen it, because I have consulted some business owners that they have they issue those, especially for business owners. They have a card, and it doesn't have a limit. It just they make the determination when you swipe it based on your pattern or your history that you have built with them. And so that will not really be a card that you want to have if you are on the stages of building your credit, because it takes away the utilization amounts, because it's only going to report the balances that you owe. So it's almost the way how you will look at it as a lender would be as a personal loan, if you will, not something that is open, but it's more of a personal loan with a fixed amount that you paying, making monthly payments to it. So what really is going to carry all the weight on that particular credit account, I'm sorry, is going to be your payment history. So that is definitely one thing that you want to keep an eye out. But yeah.
Okay, and another question that we have is in regards to the secured credit cards. Is a secured credit card a reloadable credit card?
So a secured credit card is something that you determine the amount from the moment that you open it. normally, and you can increase the amount if you want. That is totally open. But what I recommend, I've been doing this for about 18 years now, and my recommendation is always after 3 months of establishing a secure credit card. That again goes back to one of the questions that Andrea asked, about the time frame. How long does it take for all that information to be updated and reflect on your credit profile? So what I tell people, if you open a secured credit card, wait 3 to 6 months after that time frame. Go ahead and apply for a conventional credit card. And the reason why I say that is because you now can go ahead and rely on a traditional credit card and get the money back that you used, and have it in a small emergency savings account, if you will. But to answer your question, if you want to reload it and bump it up, you are more than welcome to do so. We will definitely assist, if that is one of the avenues that you want to explore.
Next question is, I'm not clear on the difference between the credit scores used by the three credit agencies. Max at 850 versus the FICO scores over 900. Can you please explain?
Again, it goes back to the what we were talking about, FICO and Vantage. Vantage, the way how they do their credits, it's going to be slightly different. So theirs actually, because of how they report credit, they look at the different factors. So their rating is actually going to be a little more than the FICO, which is 850. So because of that, you will probably see that 900 credit. But again, that it's not as popular. Well, I'll take it back. It is becoming a little more popular, but the one reliable, the one that just about, I would say maybe 85% of the lenders use, is going to be the FICO score. And that one, it's 850 is the max. But again, trust me, if your credit it's in the 800s, you are safe to say you are in an excellent credit. So you're fine. You're in good hands. Having a 850 versus having a 750 as a lender, it's the same thing for us. There's no really, doesn't make any difference. And again, that's I'm talking about 100 points, right? So 750 or above, your goal. But again, if you are in that bracket, if you will, you're perfect. So it would be the same thing for if you're looking at the Vantage score, where if you're between 8 and 900, you're good. So nothing too much to worry about on that particular case.
Okay, thank you so much, Milton. I believe though, just kidding, I just lied. So we have one more question. I have a $15,000 credit limit on a credit card and a 5,000? 5,000. Is that the maximum 30% utilization rate to keep a solid FICO score? I find my FICO score lowers if I could charge $3,000 max.
Yes, absolutely. So the if you were to do the math, the 15% of 30%, I'm sorry, of 15,000 would put you right on the sweet spot that we were talking about. So yes, ideally, again, it all depends on where you are, right? As I stated, everyone journey is different. If you already have if you are in the excellent credit score, keeping it 30% or less is just going to continue to boost your credit. But if you need to dip into it, by all means. I mean, we're not telling people not to. I mean, you have an available limit that it's a pretty high limit, and so having to use it, when needed, it's definitely something for you to consider. Again, if you remember, one of the things that we mentioned and that we recommend is to have a credit card that you keep as an emergency. So again, if you go and happen to find yourself in a situation where you need to access that line and perhaps use more than the $5,000 that you're currently using, by all means, go for it. I mean, you will probably see a small decrease on your credit score, but it wouldn't be something that it would be difficult for you to bring it right back up by simply paying as much as you can down the road. But again, the ideal recommendation is always that 30% for anyone. But you saw the example for Angela that we used with Diego. As long as you're making your payments on time, that's what really is going to have the most impact for anyone.
And we have a comment from Mr. Stan Wong. It says, so a credit card tip that might help some users to ensure you don't accidentally miss a payment, miss making a monthly credit card payment due to not maybe receiving the credit card bill in the mail, or lost or forgot to check your credit card balance e-statement, or check your credit card mobile app or website. Check the credit card selection, manage payment, and select the option to choose the minimum payment, which is going to be a fraction of the total payment monthly. Hopefully, you will have enough funds in your savings or checking account to cover the minimum payment, and you will not miss the payment each month, hence avoiding late fees. Unfortunately, you will, hold on, it moved. Unfortunately, you will still have to get a finance charge, obviously, if you can still remember to pay the full balance that same due day. You will not have incurred any finance charge nor late fees either, just a suggestion. And we have another question. What are other factors? Thank you, first of all. Thank you, Mr. Stan. And then next question is, what are other factors besides utilization that should we consider when choosing to cut up a credit card?
Oh, that's an excellent question, and hopefully this will be the last one, so we can bring it home. And again, thank you all for staying with us a little later. 7:16 already, so we went a little bit over time. But to answer your question, uh, what our recommendation is always going to be: look at the credit card that has the higher interest rate. So, for example, if you have two credit cards and one you're paying 18% and the other one you're paying 24%, it's a no-brainer. Get rid of the one that has the highest interest rate. Because again, the example that we show you here, if you're making just the minimum payments, what really is going to have a big impact on your personal finances. And remember, and I wanted to emphasize and leave you with this, that your credit score is not a picture of your financial situation. So don't judge a book by a number, I guess, or normally we say that don't judge a book by its cover, right? But don't judge a person by the credit score, because somebody that is very wealthy can easily have a lot of money and set aside in liquid assets, but be reckless when it comes to the credit. And so if don't happen to be on that situation, be wise when choosing the type of cars you want to have open. So if you're able to manage and pay off the balances on your cars, and you want to start, being more proactive, and you put in your budget, and then you look into the situations and see, okay, who's giving me more credit history, who is charging me more interest, and then make the decision based on that. And again, I know if you are like me, I am what's the word I'm looking for? A hoarder, I guess. I don't like to get rid of things. I hold to a lot of things, including cars. But if there's a time and place, that sometimes you just gotta get rid of them and then move on and start fresh. But it will definitely have a huge impact on your finances. So a lot of great questions. Love all those questions. And I'm gonna stop talking here, so I'm gonna hand it right back to Eddie and Jornika.
Jarnika, I think you can agree with me that it was such a great night of engagement. a lot of questions, a lot of conversation going, in the chat. And we appreciate each one of the comments. And most important, we appreciate each one of you, the attendees, because we do this for you, but also without you, this wouldn't be possible. So thank you very much for everybody that joined us this evening. And Jornika, do you want to invite everybody for next week's webinar and do the closing remarks?
Yes, absolutely. Thank you, Eddie. Milton, as always, that was amazing for you to be gone for a while from presenting, coming back and knocking it out the ballpark. That was amazing. I hope everyone learned a lot. Stay tuned for next week's webinar. The topic for next week is going to be, Milton, do you know what next week's topic is going to be?
Can I say?
Or
Please do.
Carrie?
Carrie's still in.
Sorry, it's car dealer financing traps. So about how you can get taken for when you're buying a car from the dealer financing office. So we're going to have
That's a good
Elton
one.
from Consumer Lending review an auto loan contract just to go over key things. And then we have a co-host who used to be a dealer financing manager. So he's got some good
Ooh.
Oh, that's going to be awesome. I'm very excited for that. And I'm sure you guys will learn a lot. And we'll go ahead and wrap this up. Again, thank you guys so much. I know we're a lot over time, so I appreciate each and every one of you. To the amazing panelists, thank you guys for all that you do. And with that being said, thank you guys for joining us today.